Hello everyone, welcome to BISP Solutions. BISP Solutions is a tech company that provides technical solutions across the world. So in our previous webinar, we have discussed about analyzing the ratios of our company, which we have taken Eicher Motors, and also what TMV, which is time value of money, is, and we have also discussed present value, future value, annuity, perpetuity, etc. And also we have learned about it in deep in our previous sessions about it. So now we will be understanding forecasting and how we can make forecasting for the company we have taken for valuation. So directly we will be going to our Excel sheet. So this is what our ratio analysis looks like in our previous session, which we have already analyzed in terms of sales growth, gross margin, net margin, sales expenses, percentage of sales, return on capital employed, debtor turnover ratios, debtor days, CFO upon total debt. In these we have analyzed our ratios of Eicher Motors. Now coming to our forecasting, we have discussed about why we are doing forecasting. It's just a prediction that our company will now what we will be doing, we will be completing our forecasting. Forecasting is not 100% accurate, but we can do for our company. So I am taking first of all forecasting for my sales, and then I will be taking for my EBITDA and earning per share. So now what we will be doing, I will do one thing. I will be giving my year weight as 1, and now I don't want to do any extra thing, so I am just copying and pasting it till 17. So 14 is there, we want till 17, right? Now as per our years, we will be taking 2016, and after that what we will be doing, it will be showing us 1905. Why? Because we have to customize it, so we want only short date. So this is what short date is, and if we click on Control+1 and go to our date, and after that we will be going to our custom, and after that now what we will be doing, we will be changing our date to only YY, just a second, like that. Now we want 2016. Why it is showing it like that? Because we haven't linked it. So we will be doing equals to, first of all, do one thing, remove all the functions from this area so that it will be easy for us. So just a second, right? Now what I will be doing, years is equals to data sheet. We will be taking our years from our data sheet, and done. Control+C. So it is taking C17, so we have to see, so it is taking this. So again forecasting, and we have to understand that in 2016A it is C16. So what we will be doing, we will again going to our March 17, control plus C, sorry, no, it will be giving us the same thing. Now this one was C16, this was D16, this might be E16, right? F19, so it will be giving us 1900 only, equals to, again we will be linking our whole data. So equals to 2021, okay, sorry, datasheet 2021, then equals to datasheet 2022, then again datasheet 23 and datasheet 24, done, and here it will be this plus 366 days. Now this much, and now what we will be doing, from 2025 to 2032 we will be making it F as it is a forecasted data, right? Same thing will be copied from here and pasted to this place. So it will be taking us to different data. So again, right, for 2023A, control alt and V, formatting should be done for right. So again the years will be same for every single heads to be calculated, right, and this will be pasted with formats, right? Now if I want sales, so I can take it from my data sheet also, and I can take it from my historical FS. So what will I do? I will be going to my historical financial statements and linking it with my sales over here. Control plus C and drag it till the 24, as we have data till that place only. So it will be taking different data, or we can do one thing for sure, equals to data sheet. So yeah, it is taking the whole data, right? Let us check if it is correct or not. It is taking for March 2017 7033. No, it is not taking. So again what we will be doing, equals to, again we will be linking it with this, equals to 2018, equals to 2019, equals to 2020, equals to 21, equals to 2022, equals to 2023, right? and equals to 2024. This much data we were having, right? And now if I want to calculate my sales growth for 2016, I don't have any. Before 2016 I don't have any data, so what I will be doing, I will be dividing my 2017's actual data with my 2016's actual data with -1, so that I will be getting my sales growth, right? So for calculating sales growth, I have to deduct my current year with my previous year, and I will be deducting 1, so that I will be receiving sales growth for the same. So yeah, that's like the error division comes because I just dragged it till the 2032 and it doesn't have any calculation in that. Right now what I will be doing, I will be taking this as gray because I will be doing calculation here, then control plus C and paste it till the end. Here also same thing, then color it out this much also. Right now what I will be doing, I will be taking forecast function. Now I want to forecast for my 10th, and my known wise is this one, and my known x's is my year weight, and then I will be closing the same, control plus C and drag it till the end, right? And the same formula will be given to this side. Now I will be calculating my EBITDA. So for that I have already calculated in my historical financial statement. Again and again the same thing will be done, equals to 2019 equals to 2020 equals to 2021 equals to 2022, yeah, and equals to 2023 is this, and equals to 2024 is this, right? Now we will do formatting. Same formatting will be done for this place also. We want only formats to be copied, so yeah, again the same formula will be applied over here also, so just for checking, right? And same formula will be applied here also. Just do one calculation or one part of calculation and it will be resulting in other heads also, we can calculate it. Now EPS is earning per share, so we can take it from our historical financial statement where we have calculated our earning per share is this. Then again historical financial statements for our March 17 equals to March 18 and March 19, then March 20, then March 21, then March 2022, then March 2023, and then March 2024. We will be doing some formatting over here till the end, control alt and V, format to be copied. So this will be expanded and this will be colored, and again the same function will be used over here also. So control plus C over here and control plus V, and drag it till the end, right? And the same formula will be applied over here, and the same will be done. So what we get from this forecasting, that from 2025 to 2032 we have forecasted that our sales in 2024 was 16,535.78. So our sales growth was about 14.50% in 2024. Right now in 2025 it might get decreased because of some issues or anything, or if there is any changes in raw materials amount, so sales growth can be declined, right? But from 2026 it will be rising from 7.77%, then 7.32% will there be increase, and after that 8.62, then 8.92, and 7.09%, like that it will be calculated, right? Then EBITDA also we have estimated that it might increase from 16.39% if there is any issue regarding the depreciation or amortization, like that. Same thing will be with our earning per share. So now moving forward to our next topic, which is our DCF, discounted cash flow, where DCF helps us to find out what is the value today of cash flows you will receive in the future. So for example, if I want to buy a tea stall from someone, so the person tells us that the stall earns 10,000 rupees every month. So if I am buying a tea stall and that particular owner tells me that that stall earns 10,000 every month, so if I estimate it for 1 year, so I will be getting 1,20,000. So they will be asking us, now would you pay 1 lakh rupees or 2 lakh rupees to buy it, right? So why is DCF important? So it helps investors or business owners to decide whether to buy, invest or sell a company, and understand how much money a company will really make, and compare the value versus the price, right? So key concepts in DCF modeling, first is our cash, where how much money is the business really making, right? So for example, if we run a tiffin service, so after buying groceries and paying your delivery boy, you are left with 5,000 a month, right? So this 5,000 is our real cash, what goes into our pocket. So in DCF this is called free cash flow, the money the business has left after all expenses, right? Then comes our key concepts in DCF modeling. So second was our growth. So as we discussed in our accounts when we were in 11th or 12th, so we understand that there is 3 golden rules of accounting. So in DCF modeling there is 3 golden rules where we will be dealing with, like cash, growth and risk, right? So our second one is growth. So how much more money will it make in the future? So for example, my tiffin service is becoming popular from 5,000 rupees this month, and I am expecting 6,000 next month and 7,000 after that. So that is called growth, and businesses that grow fast are usually worth more. Like if I am opening, so I am estimating that I am getting this much profit in first month, then I will be getting 6,000 and then 7,000. This is what our growth in business means, right? Then comes our risk. So what if the future cash doesn't come as expected, right? So if my gas cylinder supply gets delayed, or my delivery guy quits, so I might lose money that month. So the more the uncertainty, the higher the risk. Investors don't like risk unless they get higher returns, right? Then comes our present value. We have discussed in our previous session also what is present value. So if I offer you 1,000 rupees today or 1,000 rupees next year, which will you pick, right? So obviously today, because we can spend it or save it or invest it now, right? But this idea is called time value of money. So 1000 rupees today is worth more than 1000 rupees in the future. So in DCF, we bring future cash flows back to today's value. This is called present value, right? Then comes present value versus future value. So the term present value means today's value of future money. So for example, 1000 rupees received next year might be worth rupees 950 today, right? Then future value is money you will get later. So example is 1000 rupees saved today may become rupees 1200 in 1 year. So this is what our future value of our cash means. Then comes what is annuity. So if you get the same amount of money every month, like a pension or rent, that is called an annuity, right? So if we rent out a room and get 10,000 rupees every month, this is called an annuity. So there are two types of annuity, which is present value of annuity, where what that 10,000 rupees month is worth today, and future value of annuity, where how much you will have in total after 12 months, right? So what is perpetuity? So if you are earning more money forever, like interest from an FD or royalty from a song, so that's perpetuity, a never ending annuity. So for an example, if we compose a song, it earns rupees 1000 rupees every month forever. This is a perpetuity. Then comes what is terminal value. So let's say we can predict cash flows for 5 years, but businesses go on for decades, right? So after 5 years, we estimate one big number called terminal value. It's like saying from 6th year onwards, this is the lump sum value of all future cash the company might make. Right? Then comes our Gordon growth model, which is DGM. So it's one way to calculate terminal value, assuming the company grows at a steady rate forever. So the formula says terminal value, final year cash into 1 plus growth upon discount rate minus growth, right? If my business is making 1 lakh rupees in a year 5 and we expect 5% growth, we can calculate its lifetime value using this particular Gordon growth model, right? Then comes our exit multiple method, which is instead of assuming endless growth, this method says let's assume we sell the company in year 5 and buyers usually pay 10 times its year 5 profit. So this is more common in real business sales. Then comes Gordon versus exit multiple method, where the feature is Gordon is used when. So Gordon is used when businesses is stable and long term, and exit multiple method, there it is used in startups or short term projects. Then comes feature of assumption, where Gordon growth model is assumed as constant growth forever, and in exit multiple method it is sale at a multiple value of profit or revenue, right? So for an example, for Gordon growth model, FMCG brand like Amul we can take, and for exit multiple method, tech startup or Asher being acquired, right? Then comes our understanding risk, growth and cash in DCF. So cash is how much you save after rent, food and travel. Growth is your salary increases every year, and risk, your job is not permanent or company isn't doing well. So this is what in simple terms risk, growth and cash in DCF means, right? Then comes what is WACC. WACC is the average cost of raising money from all sources like loans, equity, debt, etc. So in real businesses, investors and lenders both expect returns. So WACC tells us minimum return the business must make to keep them happy. So why is WACC important? In DCF, we use WACC to bring future cash flows to present value. It reflects the risk level of the company. And WACC formula, it is cost of equity into percentage of equity plus cost of debt into percentage debt into 1 minus tax, which is always calculated on long term basis only. Then comes our cost of capital terms. So our term is cost of equity. So the meaning of cost of equity is return investors want. Cost of debt is interest paid on loans. Risk-free rate is government bond rate, which is safer than return. And beta is how risky the company is compared to market. Then comes our finding beta. So there are two types of beta we have to find out. First is regression beta, which is calculated through stock history, and bottoms up beta, where from similar companies we are finding beta, right? Then comes our market return, where this is how much the overall stock market returns used to judge investor expectations is done. Then comes our mean reversion, where if a company is doing too good or too bad, it often returns to normal. This is called mean reversion. So number of investors based on risk. So first investor type is bank, so risk preference is very low. Mutual funds investor type is medium, and venture capital, which is high, expect big returns. Then comes our retained earnings and return, where retained earnings is profits not given as dividend, kept in business only for self-sustained growth rate. So what I explained in my previous session about the self-sustained growth rate, so they use their profits money or the money which is left with them so that they can grow without taking any debt, right? So return, how much company earns from its investments. Then comes our how does all this connect to financial modeling. So financial modeling is like creating a future map of the business. So DCF helps decide is it a good investment, and ratios help us judging performance, and WACC helps us understanding risk, and growth shows us where the company is headed towards. So let's take an example for the same we have understood. So forecasting we have understood, and TVM, which is, let's say, a small amount we are taking for calculation. So I have 1000 rupees today, right? If I put in a bag for around 10% of interest rate, so if I calculate my interest, so I will be getting 100. So next year I will be having 1100 rupees. The interest also is calculated in this particular thing. So my 1000 rupees become 1100, and my 1000 rupees is more valuable than 1000 rupees next year, because I will be getting 100 rupees next year on my particular investment. So this is what our time value of money is, right? Then comes our present value, where I will receive 1100 rupees after 1 year. My bank interest was 10%, and my today's value of money was 1000 rupees. So it answers us that how much should I invest today to get 1100 rupees after 1 year, right? Then comes our future value, where if I have invested 1000 rupees, so at 10% rate of interest, after 1 year I will be getting 1100 rupees. So my 1000 rupees future value is 1100 rupees. This is called as future value, which is FV. PV is whatever the amount we are having right now, and annuity is if you get 5000 rupees every month for 12 months is called as annuity. Then, as we have discussed today also, that there are two types of annuity, where is present value annuity and future value of annuity. So present value, we will receive 5000 rupees for around 12 months. So if my bank interest is 10%, so those payments are not equal in today's term, so we calculate how much that total is worth today. So it will be around 60,000 rupees worth today. And if we calculate our future value of annuity, so we are saving around 2000 rupees per month for around 12 months, so we will be getting with interest 24,000. So that is what our future value of annuity means. Then comes our perpetuity, which we have discussed in today's session also. A university receives a donation of 10 crores and uses it to pay 50,000 rupees every year to a student forever. So that is what perpetuity means. Then comes our TVM importance. So if we are winning a prize, right? So we have two options. That first option is take around 1 lakh rupees now and you can use it anywhere. And option B, we will be getting 25,000 rupees every year for around 5 years. So if we are taking 25,000 every year for 5 years, so it will be giving us around 1,25,000 rupees. So the future payments are worth less in today's value. So if interest is 10%, we will be going with our option A, and then we can invest it in some plans for us. Next is our WACC, where if we want to calculate our business is funded, so 50,000 I am funding from my savings only, where I am not getting any interest. And if I am taking 50,000 from my as a loan from a bank, so I am getting 10% of interest rate I have to give them, right? So our average cost of capital will be 5%, which is from 0% from savings and 10% from loan. So if we average it out, so we will be getting 5% of our cost of capital. Then if we understand DCF case study, the story of Ravi's chai shop. So Ravi owns a small chai shop. He is planning to sell it, right? So if you are thinking to buy it, but you don't want to guess the price, so we want to now calculate how much it's really worth using DCF modeling. So in year 1 I am getting 1 lakh rupees, in year 2 I am getting 1,20,000, and year 3 I am getting 1,40,000, year 4 I am getting 1,60,000, and in year 5 I am getting 1,80,000. So these are the future predicted profits, as we can say it as free cash flows. Then we will be deciding a discount rate, which is WACC. So we think about inflation, risk of T business, and also we understand required return. So we decide I want at least of 10% return every year. So my discount rate will be 10%, and if I calculate my 10%, it will be around 0.001. So if I want to calculate discount each year's cash to today's value, so if I am getting 1 lakh rupees, so if I use my present value formula, so what I will be doing, 1 lakh divided by 1 plus 10 to the power of 1. So I will be getting my present value as 90,909, right? Then 1,20,000, it will be divided by 1 plus 10 to the power of 2 for 2 years. So I will be getting 99,174. So my present value, future cash flow, what I am thinking, but my present value will be this. So if I calculate my future values, so I will be getting around 7 lakh, but if I calculate my PV, which is present value, it will be around 5,16,315. So if I add the present values, I will be getting 5,16,220 rupees, which is an approx. I have removed the decimal sign. I want only the rounded up data. So total is our 5,16,220. So this is the value of cash we will be earning in 5 years in today's term, right? Then if we add our terminal value, which is Gordon growth model, so we expect Ravi's shop to grow at 5% a year forever after 5 years. So growth is 5%, and we calculate it by percentage, so 0.05 is there. So if we use Gordon growth formula, so our TVM is, we are taking year 5 cash into 1 plus growth upon discount rate minus growth rate. It will be giving us 37,80,000. Now if we are calculating discount back to this today, so we will be getting 23,46,021 rupees. So final DCF value we will be getting of Ravi's chai shop is 5-year cash flow PV is 5,16,220, and terminal value, which is PV, is 23,46,021 rupees. So I will be getting total value of 28,62,241 rupees. So my final answer will be, based on Ravi's future earnings, his chai shop is worth today 28.6 lakh rupees, and if he asks for 40 lakhs, it is too expensive for our budget, and if he asks for 20 lakhs, it is a good deal. So what we have understood with this particular learning, step 1 is founding future yearly cash profits. Step 2 was to choose your expected return, which is WACC, and step 3 is converting future profits into today's value. My fourth step is to estimate value beyond 5 years using terminal value, and my fifth step will be added everything to get total value of the business. So we have discussed many things today. So we have learned that valuing a business, it's not just about guesswork, it's about understanding how much cash it will generate, how fast it can grow, and how risky that journey might be. So that's the core of discounted cash flow modeling. We simplified it with a chai shop story, and now you know cash, which tells us how much a business earns, growth tells us how much more it can earn, and risk tells us how sure or unsure that earning is. So with tools like WACC, terminal value, and a bit of common sense, we can decide whether a business is worth buying, selling, or investing in, right? Not with emotions, but with logic and clarity. So the next time someone offers you a share in a company, a startup pitch, or a small business deal, don't ask what's the price. Ask how much will it earn me, how fast can it grow, and what can go wrong. So that mindset is what turns a regular person into a smart investor. Thank you for joining, and remember, good investing always start with good questions.